I now hand the conference over to Mr. Ashwit Desai from Emkay Global. Thank you, and over to you, sir.
Yeah, thanks, Faizan. Good evening, everyone. We welcome the management of Berger Paints. Thank them for this opportunity. It's a pleasure to host them for the Q earnings call. From the management, we have with us Mr. Srijit Dasgupta, Director Finance and CFO, and Mr. Sujyoti Mukherjee, Vice President, Finance and Accounts. I'll now like to hand over the call to Mr. Dasgupta for his opening remarks. Over to you, sir.
Thank you, Ashit, and thanks to MK Global for hosting this. Good afternoon, ladies and gentlemen. May I, on behalf of Berger Paints India Limited and my colleague, Mr. Sujyoti Mukherjee, extend a very warm welcome to all of you to our Q4FY21 earnings call. I hope that you and your families have stayed safe and well since we spoke last. I will begin this session with the customary comments on the quarter, some comments on the year's business, and then take your questions. I would, however, request you to limit your questions to the quarter or year under review. This has been quite a roller coaster year, ups and downs caused by the disrupting influence of multiple waves of the pandemic. Markets were shut for the whole of April, though we saw a strong bounce back when the markets eventually opened. In terms of our deco business, our newer products like Long Life 7, Easy Clean Fresh, Silk Breathe Easy, as well as our construction chemical products did exceedingly well. It was also a year when we could revisit our overhead spend structures, particularly in expense heads like traveling, rents, works upkeep, maintenance. However, we were mindful of the need to sustain our advertising and promotional spends and restored the expenditure to pre-lockdown levels very quickly after the lockdown eased. We could also address the raw material costs through renegotiation, innovative reformulating, and substitutions on an accelerated trajectory, which probably may not have been possible in a normal year to this extent. I will now offer my comments regarding the quarter that's gone by. I'll start with the growth numbers for standalone operations. So these are growth percentages. Total income from operations grew in the quarter by 53% and in the year by 5.8%. PBDIT was, of course, affected by the fact that other income had dropped sharply in this quarter because we had no dividend income to that extent as we did in Q4 of FY20. So I'll read out the growth numbers for PBDIT excluding other income. I think this is a more comparable figure, the two quarters. So that's 58.6% growth in Q4 and 14.5% in the full year. Similarly, I'll read out the PBT numbers excluding the effect of dividend and other income. So that becomes 79.7% growth in the quarter and 15.4% in the full year. PAT, excluding again the effect of dividend, would be 91.2% growth versus 13% for the full year. There was a gross margin expansion in the quarter of almost a percentage point versus Q4 FY20. Though compared to the trailing quarter, it was pretty much around the same level. Even though raw material prices rose sharply during the quarter, the effect on gross margins was mitigated to some extent because of the inventory effect of earlier purchases at lower rates, including some strategic purchases. The ratio was also improved because of the effect of some additional institutional business in our decorative and protective coating lines through some supply-apply contracts, which, as the name suggests, have the effect of depressing the raw material to sales ratio. This happens because the top line includes the application element as well, and therefore the gross margins tend to get depressed because of this feature, but simultaneously the expenditure also goes up because the contract work charges get included there. However, raw material prices, particularly for solvent-based products, saw the highest increases in the quarter. Phthalic anhydride, soybean oil, penta, solvents grew very sharply, rose very sharply in terms of prices, as well as did monomers, which go into emulsion production. There was a strong performance in the quarter of newer products, I mentioned some of them, and construction chemicals, which helped the top line growth as well, in addition to the lower base factor and the fact that the larger towns also opened up. Manpower cost ratios improved significantly over Q4FY20. That can be expected because of the scale effect of higher sales in this quarter. If you recall, Q4FY20 was severely impacted, at least for us, by the imposition of the lockdown in March. Overheads were largely under control, with significant gains coming in expense heads like traveling. I mentioned this. Though overall the expense group was higher on account of the application charges for supply-apply contracts. So this explains to some extent the delta that you see positive and negative in gross margins and other expenses. Other income was significantly lower than Q4FY20, which had much higher dividends from subsidiaries, approximately 96 crores in Q4FY20 versus Q4FY21. And therefore, the unadjusted PBIT and PBT numbers are not comparable. The effective rate of tax was also higher compared to last year on account of the lower tax on dividends and the one-time effect of deferred taxation gains last year on account of change in tax rates. I now move to the consolidated growth numbers in percentage terms. So total income from operations grew by 49.5%. Full year was 7.1%. PBDIT excluding other income was 61%. Full year 12%. Obviously, for the consolidated numbers, the dividend adjustment need not be done because it's dividend from subsidiaries. PBT grew by, and this is before share of profit and loss from JVs, 75.9% and 10.4% for the year. PBT after the JV share is 78% growth in the quarter and 10.8% for FY21 full year. PAT grew by 102.2% and 9.7% for the full year. The consolidated numbers, therefore, were approximately at the same levels of growth as the standalone numbers. Strong performances came in from SBSCPL, this is the erstwhile Sabu Coatings, and STP, this is our newly acquired construction chemical subsidiary, with the improved performances from the two JVs, BNPAC, that's Berger Nippon, and Berger Becker. BG and Nepal continued to recover in Q4FY21. If you recall, in earlier quarters, they were really struggling with the effects of lockdown and multiple lockdowns, but they recovered in Q3 and Q4 to a large extent. So this is a little bit about the results. I now invite participants to ask questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and one at this time. The first question is from the line of Percy Pantaki from IIFL. Please go ahead.
Hi, sir. Could you give some idea about the input cost inflation? And my understanding is that it's pretty high. So how is it that all the companies are managing with some 3-4% kind of price increases? Is it that you have taken only the first tranche and very soon some more price increases will come through? Or do you think that with the help of some cost re-engineering, product reformulation, etc., you have sort of nullified part of the increase there, and therefore not too much price increase will need to be taken?
Thanks, Percy. A relevant question. I think the answer lies in two parts. One is, for sure, another price increase is necessary, even with the improvements that I spoke about in RM substitution, reformulation, strategic purchases. These efforts continue as I speak, and well into FY22, we hope. But for sure, we are looking at another price increase in a couple of months' time. I think this is pretty much agreed upon by everybody concerned. It's unlikely that there will be any dramatic turnaround in raw material prices in such a short term. So some kind of price increase looks likely.
Sure. Secondly, if you can just give us some idea on the domestic volume growth and how the volume value gap has trended for this quarter, because this quarter would have seen metro demand coming back, which is generally a little more higher price. So has your volume value gap come down? If you can give some data on that, please.
Yeah, absolutely. I mean, you've answered your question yourself. Absolutely true. With the metros coming back very strongly, the volume value gap is actually reversed itself to a little, to some extent, meaning in many locations the sales has outstripped the volume sales. Of course, when I talk about volume sales, I should clarify that we use a normalized metric for volume. I think I explained it in earnings calls earlier, where we negate the volume, let's say, assisting effect of low ASP products like putty. We kind of normalize it a little bit. But having said that, on a like-to-like basis, it is exactly as you say, and that's what has happened.
So for this quarter, at an overall company level, would you say that volume value are the same, the growth percentages, the volume and value?
We are 20% industrial, so that is unaffected by all of this, by tier 1 and tier 2, because the customers remain the same. But certainly for our deco business, this is applicable.
Okay, so in deco, basically the volume value is more or less equal.
The gap has for sure, been negated. That gap that you perhaps were familiar with in the earlier quarters, that has sort of got negated.
Okay. And last question from me, we are looking very.
Yeah, go ahead.
Yeah, last question from me.
Yes.
We've seen a very strong growth in Q4 this quarter, And for the full year, if I look at it, for the India business, we are at about 6% kind of growth, and maybe the decorative would be higher than that. So it seems to have been a near normal year. Of course, not absolutely normal because we have been doing double-digit growth earlier, but if it's, let's say, 8-9% kind of growth versus a normal growth of, let's say, 10-12%, we've almost covered up whatever sort of demand destruction happened in the first half of the year. We covered that in the second half of the year. So in light of this covering up already happening, would you say now that FY22 would be a normal year in terms of growth rate?
Wish I could say that, Percy. The beginning has been good, but I don't think I can say very much more. I have to restrict my comments to the year that's gone by or the quarter that's gone by. But let's hope this happens and then that there are no serious disruptions caused by the pandemic. I mean, that's obviously the spoiler or potential spoiler in this case.
But would you say that at least the demand destruction which happened in the first half of FY21, that has come back in the second half, or that also there is some amount which has not yet come back and which could come in FY22?
No, I think the pent-up demand factor is over and done with. I think whatever strong demand that we see in Q4 is hopefully a shape of things to come. That's what we optimistically hope for. I don't think there's that pent-up demand factor that will play out any further. I think it's just demands shoring up generally.
Okay. Yeah, that's all from me. Thanks and all the best.
Thanks, Percy.
Thank you. The next question is from the line of Pravin Mehta from Macquarie. Please go ahead.
Hi, this is Avi here. Hi, Sujit. Hi, Srijit. Just one thing, continuing from the last one. The input cost inflation, how much of the price increase do we still need to take? Any range you could share with us, sir?
Avi, we can't because it would be like giving some kind of guideline for Q1 or Q2. We have to stay away from it. I think in my earlier replies to the first question asked by Percy, I think there is a strong case for a further price increase. So I don't know whether that helps you, but obviously there is a gap that still exists.
Okay, sir. Okay. So the second question was essentially on the subsidiaries. Now we've seen Bolix actually do very well, almost in the entire part of the year, barring first quarter. Actually, not even first quarter. So I wanted to understand, do you believe that you've structurally moved to a better growth trajectory over there, or is this more a situation wherein the lockdown nature of Europe kind of aided growth? If you could kind of share some comments over there, please.
Yes, Avi. Absolutely right. Bolix has improved structurally. I think I mentioned also in the earlier earnings calls that we've now made forays into the United Kingdom, France, and Switzerland, and UK and some of the Western European countries hold tremendous potential as far as this business is concerned. I think it would be fair to say that Bolix was probably the best performer on an annual basis, both in terms of top-line growth and profitability in the whole group of companies in the Berger Paints India Limited consolidated group of companies. So, yes, very strong performances. Structurally, the UK business is making a difference. Poland is also jumping back into the fray. I mentioned, I think last time, that Poland and Portugal were the two best performing countries in the EU. And we are hoping that this is a structural shift to better times for Bolix.
And so would it be fair to say that it's essentially leverage which is aiding margins, or is it also a mixed play over there as well?
It is. The raw materials are pretty much similar to what we use in paint. So the ups and downs pretty much echo or mirror the fortunes of the paint industry. But they have been probably more successful, or let's say more frequently successful, in terms of getting price increases.
Okay, perfect, sir. And sir, lastly, essentially on the capex side, I mean, we had contemplated adding capacity. Now, given the current situation, the uncertainty, could you share plans on how are you looking at that? Are you sustaining that momentum or revisiting it? Any thoughts on that, sir?
I think we are committed to the expenditure, Abhi. No double take on that one. Unless there's some disrupting influence in terms of actual construction and site management, which gets disrupted because of the COVID. I mean, that's out of our hands. But in terms of our plan and our commitment, I think there's no change, and we will carry on.
So this would be, sir, what is the addition that we are proposing, and by when do we expect to get the capacity on stream, sir? Right now, the plan?
You will see some perhaps comments on this. It's a little premature for me to say right now. I can talk about rough costs, and obviously this involves substantial capacity as well. We'll be in a position to give you more clear capacity addition, phase-wise additions, perhaps in a couple of months during Q1, maybe in our annual report as well. In terms of the project costs, we are looking at upwards of 800 crores for the new plant.
800 crores, would this, I essentially was looking for FY22, I mean, any guidance on that sense is what I can pencil in.
Pretty much, I think we are committed to try and finish this by March of next year. So pretty much everything will come in this year. So a little bit of a spike compared to what we've been spending in the past couple of years.
And this is largely decorative, right, sir?
Yes, but protective coatings as well. So pretty much everything, emulsions, everything. I mean, pretty much, other than, of course, specific things like general industrial or automotive.
Okay, perfect, sir. And just a bookkeeping question, the distribution expansion, or could you share what is the reach right now you typically, if you would give us some understanding how much?
I don't think we've been giving absolute numbers. I always try to help you out by saying that this is the rate of growth for our network. And happy to say that this year we actually grew the network at a rate faster or higher than previous years. So normally we grow by about 10 or 12%. This time we actually grew by a little more than that. So good news on that front.
Well, sir, is it more like a 15 or it's substantially higher? Any number you could kind of put the percentage to it?
Let's say significantly higher.
Oh, okay, sir. Okay. Thank you very much, sir. That's all from me, sir.
Thank you. The next question is from the line of Abneesh Roy from Edelweiss. Please go ahead.
Yeah, thanks for the opportunity. My first question is on your auto JV. So essentially, if I see the customer profile...
Sorry to interrupt, Mr. Roy. We are not able to hear you clearly, sir. Please increase the volume of your device.
So my question is on the auto JV. So essentially, if I see the customer profile there, it is dominated by the Japanese players, and the market also on the paint side is dominated by the Japanese players. So having Nippon, how has it helped you over the past few years in terms of gaining market share and adding new customers? How difficult, how easy is it? Any insights you can share?
I think it has been difficult, Abneesh, to be honest, but satisfying. We have grown market share significantly. We have broken into the Japanese players, but that's not the end of the story. I think earlier, if I don't know whether you recall from earlier earnings calls of previous years, this used to be a JV which only addressed the plastic components of automotive business. And we were sort of struggling as a standalone company to cater to the other businesses ourselves, meaning Berger Paints. Now, obviously, you understand the global relationships between paint suppliers and car manufacturers, and it was becoming very difficult to break into non-Indian automotive customers in the existing company, and therefore the need to augment the JV. So once that happened a few years back, doors opened for the non-plastic paint, plastic component paint element of automotive demand for paint as well. This was a field that was catered to entirely by the Kansais, the PPG, Asians, the BASFs, etc. And we didn't really have much say. So this has happened. We have broken into some of the customers that you mentioned, but we are also keeping our legs firmly planted on the ground, going after all businesses possible, including ancillaries, including Indian manufacturers. So if that helps.
So one follow-up there, you said door has opened, but you also said it is difficult. So you are getting a very small share when you say it is difficult. What does it mean?
Yes, I mean, naturally a startup will grow little by little. We can't expect to suddenly get half the market share overnight. It's not possible. It also means that our products have to be tested, the trials done, acceptance of the samples made. It has to work on the line. So there is an iterative process, but so far it's been encouraging.
Right. My second question is on the other industry practice which has been there. So the top few players in paints do have customer retention programs, loyalty programs, etc., wherein they give the tours, travels, and all those kind of trips to incentivize sales. Obviously, it's a very good marketing tool. But obviously, in COVID, it's not possible. So my question is, do you save on that cost in FY21, or you have to replace it by some other actual monetary discounts or incentives to replace that?
See, we have to respond as the industry responds. We can't be appearing to do something which is different from others, because then we don't become or remain competitive. So yes, there is pressure to find alternative means of reward for these customers, and we do that. So maybe the physical trip doesn't happen, but the reward in some way is given to the customer.
Sure. And my last question is on the capex. You mentioned 800 crore is a very large capex for the size company. I understand the thought process. My question is, are you getting any tax incentives because the market leader got huge tax incentives for their two South India plants? Second, your logistics cost, will there be saving because of this?
Yes, absolutely. Both the questions. GST benefits are very, very significant, and these actually form a sort of funding tool for the factory itself, assuming that the projections are realized in terms of sales. So you're absolutely right. GST plays a large part in all of this. But I think the larger question is that UP is one of our stronger markets, and there is a very strong domestic demand and a very strong rationale for having a factory close to market.
And could you elaborate on the GST related savings? Any numbers you can put there?
We talk about it in the annual report and others, but it's a multiple of the eligible investment. By eligible investment means pretty much the whole of the investment in the factory.
Right.
This can be realized over 12 years.
12 years. Okay, sir. That's all from me. Thanks a lot. Very helpful.
Good.
Thank you. The next question is from the line of Tejas Shah from Spark Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. First question pertains to on pricing part. So, how much price hike did we take in FY22 already? And if, just to recollect, how much price hike we had taken in FY21, if any?
FY21 there was nothing. I mean, there would have been price hikes in isolated SKUs and in industrial business, which is 20% of our business. But in FY22, we've taken a price hike in May. That's about roughly between 2.2 and 2.5% across some of the products. But as I mentioned to someone earlier, that there is, of course, a need for another price hike.
Okay. So just to confirm, did we announce any price hike just yesterday to dealers?
Yes, we've given some, but I think these modalities are being worked out. Officially, I'm not permitted to say more than that.
Okay. So one question pertaining to the pricing part. So I'm not sure if you'll agree to it, but at least from analyst perspective, there used to be an optical discipline between the key players in the industry that price hikes used to be in certain order, that everybody used to take almost in vicinity of 1 or 2 weeks. It used to happen. Not necessarily followed by led by one guy and followed by others, but at least it used to be in vicinity. Now we are seeing that at least that optical discipline is not there. We took longer this time to respond to scenario on ground on raw material side. Asian also leader also took its time, and some of the relatively smaller player in the chain actually initiated price hike early and communicated to the dealers early. So is there any change which was there for last many years which has changed this time, or perhaps we are overreading it and there's nothing to be worried about on that?
I think your last comment is probably true. It's all a reaction of this uncertainty regarding COVID and the pandemic, and the reluctance of major players to kind of rock the boat. But as things become clearer, as things become more stable and predictable, hopefully, these price increases will become like what used to happen earlier. And decreases as well. I mean, it works both ways.
Yeah. So, and one change this time is that as we are entering this cycle, most of the key players in the industry are at a relatively higher margin base. Looking at the base, then another point that within 2 years or 3 years, we are seeing one big competitor entering the space, and there is already competitive intensity which is higher. What will be the goal seek for pricing decision? Will it be to protect margins at current level, or would it be to just be competitive and react to the competitive pressure as they come?
It has to be a bit of both, I think. I mean, one can't work without the other. One has to have an eye on market share as well as make some profit. So I think it has to be a judicious mix of both, I think. And of course, new players will come, and this market does encourage new players, I think. And we'll see how it goes and then respond accordingly.
Sure. And the last bit on demand side, any sense on demand scenario changing materially after the second wave? Because this wave has hit rural disproportionately, and you have a relatively much stronger base on non-urban centers also.
Yes, your last remark is somewhat true. Yes, we've But it's too early to read into the effects of the second wave. Hopefully, in a couple of weeks' time, we'll get indications of coming out of it. Whether a third wave will happen, who knows? It's all about now trying to understand the pandemic and the actions which are possible both on the part of government as well as on the part of industry to react to the pressures.
Fair point, sir. Thanks for all the answers and all the best, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Alok Shah from Ambit Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. My first question is on the demand outlook in the industrial paints category. Would you say that the momentum of FY20 is back or we are surpassed by any chance? That was my first question.
Sorry?
No. Yes, sir, please go ahead.
Yeah, we could hear you.
Yeah. No, so I think it's a little better than the pre-COVID situation, if that's what you're saying. Certainly Q4 surprised all of us in the paint industry. So we are hoping that this is some sort of a sustained demand, pandemic considerations accepted.
Right. And the second question, when you mention about the supply-apply contract, can you give some more sense what could be that revenue contribution, sustainability of the same in FY22? What would be the one-off from that?
You'll know soon enough. It will be, actually, it's not part of the published numbers, but we won't keep you in suspense so long. It will be part of the annual report.
Sure. Thank you very much. That's it from my side.
Yeah, I can't preempt this because it's not yet published.
Got it. Sure. Thank you for this.
Thank you. The next question is from the line of Aniruddha Joshi from ICICI Securities. Please go ahead.
Yes, sir. Thanks for the opportunity. So, sir, we have seen there are many paint companies have started offering the tinting machine at a discounted price or even free to the dealers. So now considering this, how is the strategy of Berger and what is our plan with the tinting machines? So incrementally, whether we partially fund the tinting machines or we continue to encourage the modus operandi that
Go ahead.
Yeah, sir. That is the question.
Yeah. So to answer your question, yes, it depends largely on the brand equity of the company. Obviously, where there's a strong demand pull, the tinting machines can be offered at cost or marginally above. But most companies would have a scheme of matching the revenue with the cost in terms of some incentives to the dealer in case they exceed targets. I mean, that's common in the industry. So even though originally it may be at cost, but subsequently there may be some incentives given. But for the larger paint companies, or certainly the market leader and the number 2 player, it is given to the dealers for a consideration.
Okay, and ahead too, we will have similar strategy, or do you see any change in the strategy as far as tinting machines are concerned?
It's an evolving situation depending on the market pressures and the opportunities as well, and the relative performance of the dealer concerned. So it's a combination of all of that. So no one size fits all for everybody, I think, and that's pretty much across the industry.
Okay. So last question, in terms of waterproofing products, so while we have been doing a lot of investment, last year the season got impacted due to national lockdown. This year also we are seeing localized lockdown. So how do you see the overall business panning out? Is there a shift happening from Q1 to Q2 or to Q3
or do you see the waterproofing demand should continue to remain strong?
I think so. Essentially, it's been a relatively newer business for us, but we put some weight behind it. You would have seen our campaigns on the no gyan, only begyan kind of approach to solving waterproofing problems for consumers. And that's been received very well, and also kind of been a stimulus for our allied waterproofing products. There's a group of about 5 or 6 core products which form part of this waterproofing solution set, and we've had excellent growth rates in FY21.
Okay, sure, sir. Many thanks.
Thank you.
Thank you. Reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Shirish Pardeshi from Centrum Capital. Please go ahead.
Yeah, hi, good evening, Srijit and Sujati. Thanks for the opportunity. Hope you guys are safe. Yeah, just quick question. The year which is gone by, what we have observed, and quarter 1 was a washout, while quarter 2 was picking up, and the whole industry took a position not to advertise and tried to save, and then quarter 4 we have seen a good amount of money which was spent on advertising. Now, the connect with the consumer is also one of the brand recall value. And I think what I was hinting to ask the question, is that a normal practice which is followed by the industry conserve cash, or it was one-off? And maybe if you can help me, what kind of ad spends money which we'll think which is sufficient for FY22?
I can't talk about FY22, Shirish. That's outside the scope of this discussion. Maybe we'll be a little more clear in Q1 of FY22. But talking about FY21 and the year gone by, yes, in Q1 and Q2, we certainly delayed some of our ad spends, but came back very strongly with, the kitty was pretty much unaffected and came back strongly in Q3 and Q4. So there's been no kind of cutback as far as we are concerned.
Okay. Sujit, I got the point. What I was trying to push you to little hard. I think what we have seen in quarter 4, especially in the northern belt, at least the ground reality is that the market leader took a position and started a lot of discounting and pushed everyone. So is that phenomena which I was trying to ask? I mean, let me be very honest. Is that saving which has got into advertising is plowed back in terms of promotion and incentivizing the trade in quarter 4? And if that is true, do you expect such things to happen again in FY22 if the sales are under pressure?
See, ups and downs in the incentive spends will happen, but largely being SKU affecting, they'll be reflected in the top line. It's not that we are sort of plowing back something from our promotional spends or plowing back something from our advertising spends and putting it into promotions. That's not it really. So I think one will have to understand that, yes, the pandemic kind of put everybody in a sort of watch and wait mode for some time, or certainly us. I can't speak for everybody. But once the demand unlocked and things came back to an even keel, that money was released. And it had to be done because the season both in the north and the south was imminent.
Okay. Just one follow-up. The intensity of this discounting, I don't want to put the number, but is that was significantly higher, which we have seen in quarter 4, or which was
little bit manageable?
Not really. I think essentially the whole year saw some pressure on incentives, and that's bound to happen. We were trying to mop up, and everybody was trying to mop up as much sales as we could get, but nothing specifically for Q4.
Okay, all right. My last question is on, you did mention, and I think what I really see that waterproofing is a new find for the whole paint industry. And of course, somebody is trying to encash on that. But the quick short point is that, do you really think you being a company and let's starter, we have a right to win? And maybe if you can help me, what is the, I mean, I'm not looking forward-looking statement, but what is the whole business proposition for Berger to participate in this segment?
A couple of things. I think one is the fact that, as you said, this was an untapped opportunity for everybody in the paint industry. And everybody was missing a large part of it, I think, as far as paint players were concerned. And making it and the technology involved is not so far away from paint. We've also enhanced our capability by acquiring construction chemicals companies, having a construction chemical division or sub-business line within our own company with specialists involved to kind of shore up this competency. And I think the approach has been to be a company offering a scientific set of solutions to people with different waterproofing problems, with varying degrees of waterproofing issues, and therefore different sets of solutions and products that will fit, and bringing some structure into it. I think this is working for us, and we hope to expand this business going forward.
Okay. One quick follow-up on that. You have the product also which has gone into your retail network, or at this point of time we are going slowly and trying to target the project business?
In terms of waterproofing?
Yes.
Yes, no. In every aspect. So a large part of it is the retail business.
Okay. All right. Thank you and stay safe. All the best.
Thank you. The next question is from the line of Ashit Desai from Emkay Global. Please go ahead.
Yeah, hi, Srijit. Just one question. If I look at the subsidiary numbers, which is largely our consol minus standalone numbers, the gross margin decline seems to be quite sharp over there versus what we've seen in standalone business. Historically, the trends have been similar in terms of gross margins. Can you explain what's driving that?
I think the largest subsidiaries are really our Bolix and the Nepal subsidiaries. In the case of Bolix, the UK business offers a little lower margin because essentially we are competing without a manufacturing facility in the UK. And we export from Bolix. And also we've been in the UK business offering products which are in addition to the normal attics or external insulation products which we offer in Bolix proper. To elaborate, when we sell in UK, it's more like a project approach. So if not only do we sell attics products, but we also have to sell the other products which go into the attic sandwich, like EPS foam, or that's the polystyrene foam, or the mesh, or the accessories. These we do not manufacture either in Bolix or in the UK. And these are really trading activity. So naturally, as the UK business increases, the margins will drop a little bit. Having said that, Also in our BGN business in Nepal, we were a little under pressure in terms of margins, and hopefully going forward we'll be able to correct it. These are the two largest subsidiaries in the consolidated numbers, and also the fact that we had very severe margin pressure, even though the top line was fantastic in terms of growth in both our STP and Sabu-Coating subsidiaries. So these being largely industrial, it was sort of trying to play catch up in terms of the price increases for raw materials. These being industrial businesses, the impact of the raw material price increases were more, and this also explains to some extent why the margins contracted a little bit. But I think no concerns there. Going forward, these corrections will happen. In Bolix, the price increases have already happened. We've taken some price increases in Sabu-Coatings. We are likely to take price increases in STP as well. So hopefully in FY22, all of this gets sorted out.
Got it. That's very helpful. And lastly, is it possible to call out what is the opportunity size in this project business? And I mean, based on your comments, it seems like it's going to be an ongoing thing rather than being a one-off this quarter.
Yeah, again, Ashit, it has to depend on, because these are typically supply-apply contracts where we also take the responsibility of supervising application. It means the sites have to be up and running. So the pandemic plays a large role in all of this. So we are hoping that we'll get many more of these projects going forward. But in the near term, it's going to be dependent a little bit on the pandemic situation.
Any sense on the size of this segment?
We are relatively new entrants, so hopefully we are going to make this a significant part of our business going forward. But it has to make sense from a margin perspective as well. I can't talk about numbers. As I said, some numbers for FY21 you'll see in the annual report.
Got it. Thanks and all the best to you.
Thanks, Ashit.
Thank you. Participants, to ask a question, you may press star and 1. As there are no further questions from the participants, I now hand the conference over to the management for closing comments.
Hello?
Yes, sir, please.
Sujyoti, would you like to come in?
Yeah. Thank you all for participating in the call. It's been quite interactive, and wish you all good health, and hopefully we will come out more resilient of this crisis and see better times for business ahead. Thank you.
Thank you. Ladies and gentlemen, on behalf of Emkay Global Financial Services, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.